Well, good afternoon, everyone, and thank you for joining us for the Profit Planning webinar brought to you by Channel. I'll be your host today, Jenna Malpe. Our goal with this webinar is to provide valuable insights and knowledge to help increase your farm's profitability for years and generations to come. And as my social media friends would remind me, please like, subscribe, and turn on notifications for whatever platform you're on so you can get up to date information when we have these webinars and really rein in those valuable insights and knowledge. So without further ado, our speaker today is Ted Seifried, Chief Market Strategist for Zaner Ag Hedge Fund. And as we all know, the November WASDE report came out, the first WASDE report after the 44-day government shutdown, and the first report since harvest has kicked off and in the month of October. So we've kind of been riding blind a little bit in the month of October. So we're excited to have Ted on to give his analysis of the WASDE report and what we can look forward to as we wrap up 2025 and enter 2026. So without further ado, I'm going to turn it over to Ted. Good afternoon, Ted.
Good afternoon, Jenna. Hello, everybody, and thank you for the wonderful introduction. I think this is a very timely webinar, considering we've got some very wild markets and some very wild times happening at the moment. Markets were sharply lower on Friday with the USDA WASDE report, which we're going to talk about at length here in a moment. But then sharply higher here today. I'm currently looking at Jan beans up 29 cents in a almost 45-cent range today. So lots going on with these markets right now. Really makes your risk management very important. And market knowledge, understanding markets and what sort of risks lie in front of us, which again is what we're here to talk about today. So let's go ahead and get into it. Obviously, this is the Channel Profit Planning webinar. I am Ted Seifried of Zaner Ag Hedge. I am the Chief Market Strategist here. By the way, you're going to see a lot of charts in this presentation, some of which are provided by the USDA. I usually only do that when I'm doing like a report-centric or WASDE-centric presentation, because they actually provide some really fantastic charts in their executive briefing after a WASDE report. We have some of those today. Most of our other charts, or actually all of our other charts, are provided by our chief market analyst, Karen Braun, and she does a wonderful job with charts. So I think we got some really good visuals for you guys here today. So what we're going to talk about, obviously, the November WASDE results. And the reason why November WASDE is so important is because we didn't have our October WASDE due to the government shutdown. And the October report is a very big deal because, it's the USDA's really first full-on objective yield projection, which comes from a survey and it comes from field testing from their test plots. We didn't have this October, so that left the market kind of guessing of what was going on. We're missing a lot of other stuff too, export sales, just a whole lot of data that just was absent from the market for 44 days. And this November report just kind of refreshed us on all of that stuff. And so I think has a very big impact on what the market will do and what our thinking should be going forward. But there are also some kind of caveats here with that, and some maybe parallels that we can draw to last year. So we'll go into that too. That's what the surrounding context is. And then finally, we're going to talk a little bit about strategy, maybe nothing too intense or too particular, but just some ideas to kind of put in your head and to maybe talk to someone such as myself, market strategist that can kind of help you look at ways of managing risk and also managing opportunity in these markets. And then if there is some time at the end, we can take some questions. So yeah, let's get into the WASDE. I think the first thing that we have to address here is that at the top of this World Agricultural Supply and Demands Estimate report, there was a note. And that note almost immediately drew people to say, this report is mumbo jumbo. It cannot be trusted, because the USDA right here in their note at the top of the report says due to a lapse in government funding, from October 1st through November 12th, the data sources that typically go into the report for the WASDE. Now, keep in mind, it says WASDE and not crop production. It in some cases, that the information was limited. Okay, well, that is an important note. I think that they had to do because of the government shutdown. But immediately, since everybody's attention on this report is for what the corn and soybean yields were, we wanted to say that, this report, the yields that they're giving us here are nonsense because they didn't have the data or the funding to give us accurate estimates. However, that is not the case. This was in regards to the WASDE report, which applies. It means it's talking more about the demand side of things than it is on the supply side of things. You can see in Stat Chat. So the USDA does what's called Stat Chat after reports, where you get to ask Lance Honig. He's the guy in charge of public relations for the USDA. And he's very high up in the USDA's NAS, National Agricultural Statistics Service, who again is in charge of the USDA, or in charge of the WASDE report. He was asked, directly, like, okay, does this mean that we shouldn't really trust these yields? And he said, no. To be clear, that the crop report numbers were done just the same as they're always done in any given year. And in fact, they were actually done in October. However, the report wasn't released. They didn't release an actual yield number for October, even on this report that we had in November. But they did the data in October, and they did it again in November. And when it comes to the survey was there, and their yield data, their field data was there. So here's where they landed. They left the corn yield, or they slightly lowered the corn yield to a 186 national average yield, down from a 186.7. That's what we saw in September. Again, there was no October report. The average trade guess was a 184, so it came in well above trade expectations. And the trade as a whole was looking for a pretty decent reduction in that corn yield. I would go as far as to say that I think the market as a whole was maybe looking for even more of a reduction in that corn yield than what the average trade guess was, because of all of the talk about disease that we've heard in the last couple of months. We certainly know it was one of the drier Augusts that we've had in a while. It was the driest August since 2013 or 16, in a decade, really. Then those factors coming together, and the harvest anecdotes that we've been hearing, were leading us to believe that the USDA was going to have to lower yield more than what they did. So that was a bit of a bearish surprise to the market. But again, a lot of people are saying, yeah, but limited data. Again, they really put that to bed, saying that the limited data or the government shutdown did not affect their yield estimates. So these are the numbers that we have, and they will not change until January. We'll talk in a moment about how they could change in January. But at least for now, this is the number that we're looking at for corn, a 186. And then for soybeans, a 53 national average yield, which was pretty close to the average trade guess of 53.1, but only a half a bushel lower than what the USDA had said in September at 53.5. And again, very dry August. August is that month where the soybeans are most moisture sensitive. And so, myself included, I really kind of thought the USDA would have justification, or would go out and find in their survey and in their field data that yield was going to come down more than what it did. So that was another, I'm going to say, a little bit of a bearish surprise for the market. However, if you look at what we're doing today, we've really kind of shrugged off these numbers from Friday. And again, I think there's a couple of reasons for that. We'll get to that a little bit later, but I'm gonna continue to sort of talk about yield, because right now that is the biggest question mark, at least from the USDA side of things, that we have, right? And so just kind of a history of what has happened with those corn and bean yields. The high water marks for both corn and beans came in August. The USDA was all the way up at 188.8 on the national average yield for corn and 53.6 for soybeans. And those numbers have come down, right? Again, the disease pressures, the rust issues that have been, very prominent in headlines and on social media, but also that dryness in August. I'm not going to stress that. I can't stress that enough. I think that really had an impact. Um, you know, but again, according to the USDA, that only lowered yield from its potential in August. It only lowered corn yield 2.8 bushel per acre, and beans was only 0.6. So that seems like fairly small reductions compared to all the things that we've been hearing. So again, that was a bit of a bearish surprise for the market on Friday. But as the dust has been settling, it does seem like we've maybe shrugged that off just a little bit, because now we're looking forward to January and what happens going forward. Now, going back to the USDA's data set for yields, like operator reports surveyed. And by the way, this is not something I generally include in WASDE presentations. I'm doing this simply because of the government shutdown. And again, taking it a step further to say that, look, the USDA gave us the best information that they had. They did have 6,692 operator surveys, farmer surveys that came back. So they had a very robust sample size for the surveys that they were using, which is a big portion of their yield estimate. That number is actually higher than what they had last year. So the surveys that came in from October 31st to November 9th, they were there. It was more than last year. So, I mean, it's difficult to say, impossible to say that the USDA did not have data from their survey to give us an accurate yield report, or at least their best estimate on yield for this November report. And then for field surveys, they had 3,090 field surveys for corn and for their objective yield for corn and soybeans taken between October 25th and November 1st. That's a lot of field surveys. That's a very large sample size. It's maybe not quite what we've seen in the past. So, if you look at this slide, you compare it to 2020, 21, 22, 23, 24, and 25. About the only thing that you notice here is that maybe we were just a little bit less mature in some of their sample fields than what we've been in years past. But for the most part, the numbers of the samples processed was really very much the same as what we've seen. And if we look at that corn yield, we are solidly above trend line, solidly above last year's 179.3. And again, according to the USDA's November report, at a 186. It was a record yield for, or as it stands, is a record yield for corn. Again, well above trend. I mean, there were some very, very good aspects to this growing season, obviously. But again, with all the disease issues and the dry August, I think a lot of us thought that yield would come down. And keep in mind, the USDA will give us their final production number. It's never final with the USDA. They can always revise it further on down the line. But their quote unquote final production number in January. And I do want to call people's attention to last year. They had to reduce their yield pretty aggressively in January. I think the market, for the most part, is wondering if we're going to see more of that or something similar to that this year. You look at what happened from a statewide perspective. You look at Iowa up 2.4%. You look at Illinois up 1.8%. You look at Indiana up 4%. Look at Ohio, right? I mean, these are some big changes, some big increases from year over year in the crucial I states and right across the center of the growing area. You look at Nebraska and Minnesota, South Dakota, really a lot of really good numbers out there. So, I mean, this is obviously what came together to justify that USDA's, the state by state level, came together to justify that national number. But I got to tell you, I've got guys in Iowa, in Illinois, saying, I don't know how this is possible. I don't know how these statewide averages that the USDA is giving us is possible. So we're going to have to see what happens on that January report. But again, for now and between now and January, this 186 national average yield is what we have to work with for the corn yield. Now, here's where we get into some deeper analysis on that corn yield and what the USDA numbers were. Okay, so to explain this slide a little bit, the blue bars are the ears per acre and the red dots are yield. So you can see that there's not a super strong correlation of when we have high ear counts, you can still have a lower yield. When you have low ear counts, you can still have a higher yield, because what's not shown here is ear weights. Okay. However, you look at 2025 and ear counts, ears per acre, were fairly similar, actually slightly lower than what they were in 2024. Okay, and you see how the USDA had those 3 red dots in September, October, November, but then on the quote unquote final number, it dropped off. Well, you look at this year, and again, there's no October there, but September and November, those red dots are really rather high on the chart. They're record yields, but the ear count, the number of ears out there, are not records. So what does that mean? That means ear weights are really high. Now, the question there is, how do we have really, really high ear weights in a year where we had a dry finish in August? Now, granted, it was not a exceptionally hot August. So, for corn, that dry August might not have had as big of an impact on as it did on, say, soybeans, but it was a dry August and we had a lot of disease pressure. And when you say dry August and disease pressure, to me, that means that we could maybe see some lower ear weights. So if there was a number to come down in USDA's equation or formula to give us a lower yield in January, it would be that ear weight number. And you can see right here on this chart that would be, there's a pretty easy argument to be made for that. There's a pretty clear path for that to happen. So again, I think this slide right here is why the market is able to sort of take that USDA's number with a grain of salt. You combine that with, and by the way, this is the overall production number, just showing here that is under the current USDA's assumption, this is a record production. If we lower yield, if they lower yield, this number could come down. It likely won't come down far enough to take us out of a record production number because of the amount of acreage that we had. But as it stands, I mean, it's a record production by a lot. And to go back to, the changes that we see monthly, or from November to January, and then Sep to Nov. Normally I would do Oct to Nov, but, again, we didn't have that October report. The Oct to Nov reduction that we had last year was fairly slight. Or the Sep to Nov reduction that we had last year for corn was fairly slight. The Sep to Nov reduction that we had this year was a little bit bigger, but still fairly slight. When you go to the slide on the left and you see 24 had a pretty massive reduction from November to January. Obviously, there's no 25 on this chart because January hasn't happened yet. But that was a really big reduction November to January, even though there was not very much of a reduction from September to November. So this slide, along with the slide that we saw on the USDA's ear count versus yield, these are the two slides that when you put them together, allow you to maybe say, hey, there's a possibility at least that there could be a fairly decent reduction on the USDA's yield when we see it again in January. But what I will say, I do want to caution people that are saying, 178 or 179. That is more of a reduction than I think is likely. If we talk about maybe a 2% reduction, we're talking 3 to 4 bushel an acre. So, I mean, I think at this point, I'm using a 182 for a national average yield. That's 4 bushel an acre below where the USDA is. But I do think that it would be a little bit shocking to see anything drop below, say, a 182. So do keep that in mind. Now, let's talk about soybeans. here's the samples processed in the lab. You can see there's not much difference than what we've seen in the years prior. So these numbers kind of hold up with the USDA's statement that the government shutdown did not affect their yield estimates. And you can see the soybean yield very similar to corn. It's above trend line. This is a 53 national average is a record yield for soybeans. And again, that dry August, in my mind, made that number a bit questionable. But at least for now, the USDA is holding us to that record yield. And where did it happen? Really everywhere, right? I mean, look at the heart of the Midwest, but look mostly towards the West. You got to say that for soybeans, I do feel like, the strength coming in the West, that sort of does make sense to me. For me, I had a 51.7 national average yield for soybean. That's still where I'm using on my longer term balance sheets. But I don't know. I mean, I think you would have a lot of producers maybe argue with this map. At least the guys that I've talked to in the last couple of days have. Now, we'll do the same thing kind of we did with corn. So this is pod count. The thing that this doesn't really incorporate is pod weight. So this paints just a little bit of a different picture than corn because the pod counts were really very high there, right? And so the potential for a big record soybean yield was absolutely there. But I'm going to say pod weight has a lot to do with the overall yield formulation. And, if you look at like 22, we didn't have all that high pod counts, but we had a pretty good yield. That was all done by pod weight. I don't know, pod count, if you're not getting any weight out of some of those pods, that could really affect yield. So even though the pod count number was out there, it doesn't necessarily mean that yield is exceptionally high. Again, here too, I think there is a case to be made that because of pod weight, we could ultimately see that soybean yield come down in January. Soybean production was not a record, even though the USDA is currently talking about a record yield. That is a function of lower acres. We really didn't plant a whole lot of acres this year. I think that was a reflection of the concern about trade with China, which obviously that was a valid concern since up until recently, China had not bought any soybeans from us. As of right now, the expectation is for them to resume their buying. We even saw a note on the USDA report on Friday that the USDA is expecting the China buying to resume in a bigger way. I think when you look at the market today, there is a lot of expectation that China might be actually buying today or will be buying very soon. So that expectation is out there. But when we were planting, there were a lot of concerns about that. Now, same thing that we did with corn, we're looking at the changes that we saw from September to November in soybeans. That's on your right. Not a very large reduction in 2025, not as big as that reduction that we saw in 2024. Okay, but then you go over and you look at 2024 from November to January, and there was a fairly substantial, almost 2% reduction in the USDA's yield in January. So again, you kind of compare that to what we saw September, November last year to what we saw September, November this year, and you suggest and you say, I think there is a likelihood that USDA might have to come down in January. However, you also might say that maybe based on the larger reduction that we saw in 2024 versus what we saw in 2025, that maybe they don't have to come down as much. I mean, that's a double-sided coin. You could argue that maybe they'll have to come down more. Either way, it's interesting to me to see the reductions that we had from Sep-Nov in both 24 and 25, and then to compare that with how they finished in January of 2024. So there was a lot about yield and a lot about production. Now let's get into the bigger picture of how that all ties into the bottom line, the ending stocks number. And for a U.S. ending stocks number, It came out for corn a little bit above expectations. That's a function of the higher production number than what the average trade guess was, but it came out a little bit above expectations at a 2.154 billion bushel carryover. It's a big number for corn. And that's the thing that's really held the market back from being really very bullish for corn. Part of that, by the way, was because we had an extra 207 million bushels coming in from beginning stocks. On the quarterly grain stocks report that we saw at the very end of October, basically the day before the government shutdown, the USDA, the survey that they had, it ended, the quarterly grain stocks number is a survey, so it's not them just making up numbers, showed an extra 207 million bushels for last year's carryover. Again, that was added to beginning stocks. So we had that offsetting that increase in beginning stocks offset the lower yield number and did offset an extra 100 million bushel increase on exports. So at the end of the day, we still have a 2.15 billion bushel carryover in corn, according to the USDA. That is a big number. For soybeans, carryover did come down a little bit from that 300 million bushels that we saw in the September report, but only marginally, only 10 million bushels. Part of that was the lower production number. Again, they cut half a bushel yield off, but they also reduced exports by 50 million bushel. And that is even considering that policy in place is that we do have a trade deal with China. I'll get into that a little bit more in a moment. But you look over at world ending stocks, there's nothing terribly interesting there. Yeah, soybeans were a bit lower than what the average trade guess was. So I mean, some a little bit tighter than expected global carryover, but still well above the 100 million bushels that we were seeing a couple of years ago. There's still a lot of soybeans in the world, according to the USDA's global balance sheet. There's a lot of corn in the world. There's a lot of wheat in the world. That wheat number jumped very significantly, by the way. There were some pretty big production increases coming from other countries. The only reason I bring that up is that lots of world wheat ending stocks could maybe creep into the global demand for corn for feed. Other than that, I'm really not going to focus on wheat here today. So one of the things that a lot of people have talked about on the corn balance sheet is that the feed and residual usage number for corn is up very dramatically from last year to this year. And we don't really have the animals out there to suggest that. And while I can say, all right, maybe that is the case for feed, the big part of this, don't forget about the residual portion of it. And the point of this slide is that, whenever we have a really big increase in production, we almost always have a big increase in that feed and residual category. And, when you look at the years that we have had in the past, you can see other years like 16, 17, for example, or 23, 24, where you have a sizable increase in production. It usually almost always comes with a sizable increase in the feed and residual. Now, the one thing that I will say, though, is on 13, 14, we had an unproportionate increase in production versus the increase in feed residual. I could see a possibility that that ultimately the feed and residual number is overstated by the USDA. But here's the thing about that. If yield does come down in January, I think the feed and residual will offer them a portion on the demand side of the equation to kind of offset a lower yield. And that is a bit of a concern of mine going forward. Even though, like I said, I am still thinking that the USDA will have to lower corn yield in January. In the meantime, corn exports, they did raise that 100 million bushels on this last report. And the question in my mind is that enough? Because look at the export inspections number that we have. Now, we're not completely caught up on export sales. We did not have export sales while the government was shut down. We did continue to see export inspections because export inspections were deemed essential. So we did get export inspections. And oh my, look at this. We are off to a record start on export inspections for corn. They are rocking and rolling, and it is really, really good numbers. and in this last week, I mean, the sixth best week on record since November of '89. That's not the sixth best for this week on any given year. That's for any week. That is extremely impressive, especially considering that this is not our normal or typical key corn export window. As you can see from the charts, you look at previous years, and we are really, I mean, it is basically, March through June is when our key export time for corn is. We're doing all this at a time of year where we're usually really focused on soybeans. Again, that has been a bit of a problem. So we have been focused on corn. We've got a lot of corn going out. This is a very bright spot for the corn balance sheet. The question really being is, are we going to carry these very strong numbers into our key or typical peak export season for corn? Or could they even get better? Or are we sort of front loading this export demand, and will they simmer down as we get into March, April, May, June? And I think a big answer, well, the answer to that question, I think a lot of that lies into what happens with South America, but we're a long ways from that second season safrinha corn crop in Brazil. So I don't think we'll have answers to that. It'll be interesting to see how the export sales numbers catch up, to see if, what they have to say. Because again, we've been kind of flying blind on that, but we will start to get that coming in now going forward. And again, the USDA is reflecting some very good exports on their balance sheet. They are looking for a record soy or record corn export number, well above 3 billion bushel. I think right now that's very much justified. In fact, I would almost argue that could go higher, but I do understand the USDA's hesitancy to do that right now. They want to see how this progresses as we get into that key or typical peak export season that we usually have. Now, the funds have been, well, small note on this. We haven't seen a commitment to traders report since September 24th. So these are all guesses from the trade estimates. And the last time we've had government shutdowns, these trade estimates have been wildly wrong. This is the trade doing the best it can to try to figure out where the funds are. But if the trade is right about this, the funds haven't gotten to the long side of the balance sheet or their personal balance sheets. They've not gotten to the long side on corn yet. If they were ever to decide to do so, there could be 250 to 300,000 contracts of buying potential. They're coming from the large speculators. So, corn has had a really nice bounce off of lows, but nothing like what we've seen in soybeans. I think part of the reason for that is because the large speculator, at least from our best guess or the trade's best guess, these aren't my numbers specifically. This is gleaned from Reuters, by the way, and they do this as a poll. But if the funds were to really want to get long corn, I think there's a lot of upside potential there. And you look at corn stocks to use, yeah, it's higher than it's been since 2018 or 2019, 2020. But again, if you start cutting that production number, that could tighten our stocks to use and potentially give us a little bit more of a bullish situation in corn. And by the way, the market might be trading that already. Like I said, I think there's a lot of skepticism of that higher corn yield or the fact that the USDA should maybe lower that corn yield more than what they did. Now let's talk about soybean export inspections. This is the other end of that spectrum. This is the time frame where we should be enjoying our peak season for our soybean export inspections because it's in between South America's peak season. And they've been really bad. In fact, they're worse than they were in 1819 or 1920, the first time that we had the trade war issues. I mean, we are really bad. I mean, there's no real way around saying that our export shipments of soybeans to this point are really poor. The USDA did lower our export projections by 50 million metric tons. You can make an argument that it should be a lot more than that, but I guess the USDA is waiting to see how it progresses, and especially with the trade deal with China that has been announced. But the USDA's export number overall is looking for some pretty small exports. I mean, basically the smallest that we've seen since 1819 or since 1920. And again, our export inspections at this point suggest that we could be a lot lower than that if China doesn't really increase their purchases and the shipments here very soon. Now, here's the thing about that. USDA operates under what's called policy in place. Whatever political policy that we have in place is what they use to formulate their longer term estimates. And as you can see here, it's highlighted that, since the last report in September, the US entered into a trade deal with China. That means that the USDA is expecting minimum 12 million metric tons coming from China, and probably more than that based on the export number that they're using. Problem with that is that that deal has not been signed yet. And over the weekend, Treasury Secretary Percent said on Fox News that he's hoping that that gets signed by Thanksgiving. Now, obviously, you look at the markets today, currently up 32 cents in Jan beans. There is a whole lot of optimism that that deal is going to get signed and it's going to happen, and China buys at least that 12 million metric tons. However, I do think there's still a lot of risk out there that doesn't happen. I mean, look, this trade deal has been very on again, off again, and we haven't seen the actual proof in the pudding that China is buying. Yes, they bought about 7 cargoes of soybeans, but that's nowhere near the pace to get them to that 12 million metric tons that it has been stated that they will be buying for this calendar year in this marketing season. So China needs to buy a lot more. These are the numbers that we've seen. By the way, I didn't get a chance to update it, but we saw the USDA announce a 100,000 metric ton cancellation from China here today on one of these purchases. Again, the market obviously not being concerned about that here today, up 32 cents. But these numbers, 100,000, 238,000, 232,000, 117,000. That's a maximum of 287,000, right? I mean, that's explicitly to China. That leaves a gap of 11.3 million metric tons of soybeans that needs to get sold to China in a 6-week time span. That's 3.5 to 4 cargoes per day between now and January 1st, including weekends and holidays. That just seems like a very tall order unless China comes in and makes some very big splashy purchases, 5 million metric tons at a time, things like that, or 2-3 million metric tons at a time. Apparently, again, you look at the strength that we see today, the market is thinking that is a possibility, or maybe even expecting that. But if time goes on and we don't see those, the market is going to start to get a lot more skeptical about that once again. Again, for today, the market seems very encouraged that that's going to happen. But over time, again, we need to see that proof in the pudding. And China demand is not replaceable. We get this question about demand displacement all the time. Other countries are going to buy more from the U.S. because China's buying everything that South America has to offer. Well, okay, this is what China buys on any given year. This is using 23-24 as an example. China bought 25 million metric tons from us. All the other countries combined didn't quite buy 5 million metric tons from us. Or I'm sorry, all the other countries combined. So EU is the number one. And by the way, that's not a country. That's a conglomeration of countries. Mexico, all these other countries, yes, I mean, they could buy a little bit more, and they have for the most part so far this calendar year, but it doesn't come anywhere near matching the deficit or the hole left by China if China were not to start buying that 12 million metric tons and beyond very, very soon. And so here's the market share. Even with the trade deals that we've seen, this is not just to China. This is to the rest. This is the whole world, right? And this is based on the USDA's most current global carryover. So, I mean, this is including the expectations that we are going to sell some more beans to China. We are losing market share to Brazil in a big, big way. Now, thankfully, we are increasing our crush capacity. We saw a record NOPA crush number today of 227 million bushels for the month of October. That is huge, and that is awesome. But in the meantime, we're losing our global market share to Brazil. And by the way, our market share dropped a little bit on this November report, even though Brazil's didn't gain. Well, that's because Argentina did come in and steal some of that business from us. So we have South America as a whole giving us a hard time on our global exports. And the funds, again, this is a guess. I'm not going to go into all that again, but we don't have hard and fast data for this. But it is assumed that the funds are long about 100,000. That was coming into today. It could be buying a lot more today, or could have bought a lot more today. But the funds seem to be going long on soybeans. That is in expectation of that trade deal to go through and the China to be starting to buy soybeans very aggressively very soon. I highlight this because if this is correct and China, we don't see these sales coming through, and again, soon, this leaves the risk open that the funds don't want to be long anymore and do flip the script lower. Again, this is not a problem for today. Beans up 32.5 right now. So, I mean, the expectation very much is that China will be buying. But again, as time goes by, we need to see these sales. Otherwise, there is that risk of that sell-off, at the very least, just a fund liquidation. So soybean stocks to use. And this is why the funds are long. The soybean stocks to use is the tightest it's been in 3 years. And that is even with the USDA out reducing the national average yield, which again, we've talked about, I think is a potential in January. So there is a reason to say, hey, the soybean outlook might be fairly friendly as long as those Chinese purchases are there. And the market is assuming, based on what Trump has said, Besant has said, what Greer has said, and even what the USDA said on their WASDE report on Friday, that Chinese demand will be there. That stocks to usage number is a bit friendly. So that's why the funds, I think, want to be long soybeans here at this point. And then you look at the global production. And while the USDA did finally increase that Brazil crop, which again, most analysts, myself included, have been saying that for months that they need to. They did finally increase last year's Brazil crop. They left next year's Brazil crop alone. They increased Brazil's corn crop finally, but they left next year's Brazil corn crop alone. Well, these crops still need to be grown, still need to get grown. And there was starting to become a bit of a concern about that. You look at the planting progress that's happening down in Brazil right now, and it started off at a very, very fast pace. This is in Mato Grosso in particular. It's their largest production state. And it is back down to just about the 5-year average. So they're at average. It's not sharply behind. In fact, they are pretty much wrapping up that soybean planting as a whole. But it's not been without its hiccups, and it did slow down at times, and that is weather related. Too wet in some areas and really too dry in others. And there is starting to become a concern about this La Nina forecast and what that might mean for the growing season, maybe even more so for Argentina. And if there are any bigger shortfalls in that South American production, that could really facilitate more China buying, and it could come at a time that is outside our typical export window. So this is allowing the market to feel like, okay, maybe, just maybe, if China doesn't buy right here, right now, and in our typical export window, that we might, given if there is an extended weather issue in South America, we might get to pick up some of our export demand on the back end and offset that. So again, this is another thing that's adding some optimism to the soybean market right now. We're in that time frame where we'll be watching South American weather very closely as we get into the winter months. And there is a bit of reason to be concerned about that. Now, real quick, and I know we're running short on time here, I am going to say that we started this very similarly last year with dryness concerns in Brazil. But at the end of the growing season, they ended up having a very good crop, even better than the USDA's expectations. So right now, I think it's a little bit early to get too excited about the Brazilian dryness, but it is on the market's radar. It is something that the market is watching, and it is a positive factor for the market at the moment. So let's talk about strategy. As you said, I think the corn yield could come down. I think we have cautious optimism for corn. I would say corn of all, between corn and soybeans, I think corn has the potential, maybe is the underdog, has the potential to go higher. So I think just buying puts to cover unsold production is a great idea. Or if you need cash flow, I'm all right with selling cash and re-owning a call. That's called a synthetic put. But I think kind of a looser downside protection in corn and having some upside potential is a good idea for corn at the moment. I am fairly optimistic on corn. I'm even going to go as far as to say for the first time in a couple of years, I'm sort of a fan of reownership calls or even buying calls before making cash sales to allow you to feel comfortable about making those cash sales if and when the market rallies and letting your target orders get hit. The only thing that I worry about for corn is, are we going to see another increase in acreage? But that's more of a question for when we get into January and February. So for right now, I want to be cautiously optimistic for corn and use a strategy that is sort of loosely protecting my downside. For example, again, if you like reownership calls or or if you have to sell cash, the March 470 calls at 7 to 7.5 cents. They might be more today, again, with the strength that we're seeing. They have 95 days on them. For me, I think that is a very viable reownership strategy. But for soybeans, you got to be very, very careful. Like I've been saying, this whole presentation, if China doesn't follow through on this trade agreement that we are counting on them for, and doesn't buy at least that 12 million metric tons of soybeans, I think there is a lot of downside potential. Now, we're certainly not realizing that here today. Beans now up 34 and a quarter. But over the next couple of weeks, if those sales don't come in, there's a lot of downside potential in soybeans. So I do wonder about making cash sales in soybeans, maybe looking at some call strategies, although with the amount of strength that we're seeing today, I might wait to put those call strategies on at a later date. But either way, I am wary about soybeans. And like I said, and have been saying, I'll feel a lot better when the sales start coming through for China. But if they don't, then I'm going to get real nervous about the prices that we have. 1160 to me seems like a very high price in soybeans if those China's sales aren't coming through and we're not seeing them. So keep that in mind. All right, guys. I have an Egg Hedge hotline. If you want to hear my thoughts, daily, I leave a recording from about 5 to 7 minutes recapping markets. You can call in at your leisure. I generally I try to have it done by about 2:30. It's up there until the following day. So feel free to sign up for there. That is the QR code for that. And then obviously, guys, sign up for our profit planning series. This is an email that goes out every Tuesday, and it is about grain marketing, climatology, agronomy updates straight to your inbox. I try to put out my 3 key topics for every week for the markets. It's a great thing. So sign up for that as well. And then I'll bring it to you, Jenna. This would be the portion for question and answers if we have any.
Yeah, so I'm not seeing any come through, Ted, but thank you so much for going through the November WASDE report and every other thing that's happening with the market. It is truly a wild time and there's a lot to digest. So thank you for your insights and breaking all of that down for us.
Absolutely.
And as Ted said, subscribe to our newsletter that comes out every Tuesday. So Ted will be writing for that tomorrow, and that'll be coming to your inbox tomorrow. So you can scan that QR code. But with that, I just appreciate everybody for joining the Profit Planning series, and join us next time to learn more valuable insights and knowledge to increase your farm's profitability for years